Morning everyone. I am Dr. A. Nagalakshmi, Assistant Professor, Department of Commerce with Finance in Dr. SNS Rajalakshmi College of Arts and Science, Coimbatore. I am here to explain the basic concepts of ratio analysis. So, ratio analysis is a tool used to evaluate the financial performance and health of a business by examining the relationships between various financial variables in the company's financial statements. Here are the basic concepts. The first one is the liquidity ratios. These ratios measure a company's ability to meet its short-term obligations. Common liquidity ratio includes current ratio. Current ratio means current assets by current liabilities. Quick ratio, current assets minus inventories by divided by current liabilities. The second one is the profitability ratio. These ratios assess a company's ability to generate profit relative to its revenue, assets or equity. Examples include net profit margin, that is net profit margin is equal to net profit divided by revenue. Return on assets, ROA, net income divided by total assets. The last one is the return on equity, ROE, that is net income divided by shareholders' equity. The third one is leverage ratios, that is solvency ratios. These measures the extent to which a company is using debt to finance its operations. That is common ratio includes debt to equity ratio, that is total debt divided by total equity. Next is debt ratio. Debt ratio is equal to total debt divided by total assets. The fourth one is the efficiency ratio. Efficiency ratio means activity ratio. So these ratios evaluate how efficiently a company utilizes its assets. Some of the key ratios are inventory turnover ratio. So inventory turnover ratio is equal to cost of goods sold divided by average inventory. Next is the receivables turnover ratio, that is net credit sales divided by average accounts receivables. The next one is the market ratios. So market ratios means these ratios help to assess the market value of a company's stock. Examples include price to earnings, P/E ratio, that is market price per share divided by earnings per share, EPS. Next is earnings per share is equal to net income divided by outstanding shares. So by analyzing these ratios, the stockholders means investors, management, creditors, etc. can better understand a company's financial health, profitability, operational efficiency and market valuation. So I think we got a basic idea about ratio analysis. That ratio analysis is nothing but it is a tool used to evaluate the financial performance and health of the business by examining the relationships between various financial variables in company's financial statement. Okay, so what are the ratios? We shall summarize. So we have seen liquidity ratio. Under liquidity ratio we have current ratio and quick ratio. Under profitability ratio we have net profit margin ratio, return on asset ratio, return on equity ratio. Under leverages ratio we have debt to equity ratio, then debt ratio. Under efficiency ratio we have inventory turnover ratio, receivables ratio. Next is the last one, that is the market ratio. Market ratio includes price to earnings ratio, earnings per share ratio. So these are all the basic concepts of ratio analysis. Thank you so much for the patience listening. Thank you.